Bernard Doyle here, JBWere Investment Strategist. Year started, already plenty to talk about. One question we've got from a number of clients, there has been some press commentary around the likes of saying markets are as stretched as they've been for many years, GFC2's just around the corner. Look, this is something we address in part in our year ahead piece, so if you haven't seen that, please grab a copy from your advisor. But generally speaking, this is one of our strongest messages for clients this year and most years generally, is the most dangerous thing for equity investors is recessions. Almost always bear markets are caused by recessions. So when we're thinking, as we are in the late stages of a bull market, about what could be our next problem, we invariably focus on where is the recession risk. We've seen over the past few years so many things: Brexit, North Korea, various political distress and surprises around the world. But while the world's growing, we haven't had a bear market. So that just reinforces that message. And so our view is, and the view of our research partners is, the risk of a recession in the US or one of the other major economies right now is quite low. It's not zero and it's not negligible, but it is quite low. We could always pick out various variables and say, look, this variable or that variable is back at the level it was in 2008. For example, PE ratios are high now. But no, there is no one single indicator of a crisis. Crises actually take years to emerge. They take a long time to build up. They don't come out of nowhere. And we're just not seeing the sort of broad, worrying signs of excess, of debt growth, of peaking in earnings, of valuations, all the sort of things that have to come together to actually be a very important warning sign of a financial crisis or a bear market. And in fact, when we look at the US and the European and Japanese economies, and to a lesser extent the China economy, they're all growing at a good pace, and the indicators of growth are reasonably healthy. So that's still a message from us, is we think the world looks in reasonable shape, and while it's in reasonable shape, we think equity markets will do okay. They probably won't do as well as last year, but they'll do okay. Now the second point to this is there's a very different message between a crisis and a sell-off. Now we've tipped into some very interesting territory now. This is now the longest period since 1929 that the market has gone without a 5% sell-off. So we're overdue. And so one thing I would say this year is it is unlikely we'll get the armchair ride investors managed to enjoy in 2017, where the worst sell-off through 2017 in global shares was less than 2%. That's extraordinary. But a sell-off is not a crisis. A sell-off is really the price of entry for being in the equity markets. You have to be able to absorb those 5 to 10% pullbacks that usually are recovered quite quickly. And so please don't take that as a message from us that there's no sell-offs on the horizon. They're probably, we are due for one at some point during 2018. But as for the health of the world economy, and are we seeing things that unduly worry us, we're not in that position. Final thing I'll end on, and this is very much something we have talked about for 2 or 3 years now, and have certainly covered in our year ahead piece, is we do believe interest rates are heading higher, and higher interest rates eventually could be something that slow or reverse the good return environment we've been having in equities. So we can see the process in play. We think rising interest rates will ultimately be a good thing, but it's something we're watching. And you've seen this month and last month US 10-year treasuries have been rising reasonably sharply. And that's something that'll, that's one of the key reasons we've recommended to clients to hold less bonds than normal, because bond portfolios tend to struggle a little bit in a rising interest rate environment. But as I say, this is something I regard as quite healthy. The rising interest rates ultimately reflect the fact that we are getting a sniff of maybe a little bit of inflation coming back into the world financial system. That of itself is not a crisis or not a cause of a bear market. It is an area we're watching. Look, I'll finish here. We'll give updates as the year progresses. And as always, please get in contact with your JBWere advisor if you have any questions for us that you'd like to delve into in more detail. Thanks.